And I think with that, we can transition into our main topic, which this week is the lawsuit from law firms Selendi and Gay, as well as Roche Cyrulnik, who filed 11 class action lawsuits against many of these crypto exchanges. And Herwig, I'd love to hear a little rundown from your perspective.
That's right. Last week's episode of the show contained an update regarding the famed Telegram ICO case with the SEC. But for those of you who did not catch that, the short version is that a global $1.7 billion with a B dollar ICO has been halted because the SEC is investigating the issuer, which is a messenger company with over 300 million active users, for violating securities laws with the ICO. The update last week was the judge has supported the SEC in their request to halt the issuance of Gram tokens to buyers, which was meant to occur this month as a major event. Now, the details of the case are that Grams as tokens were sold in a way that violated securities laws. This has been the case for many ICOs who, from their perspective, might be issuing utilities or pieces of software meant to interact and function within a blockchain ecosystem. Certainly not something meant as an investment opportunity. Some others may look at it as a way of something more akin to investing in rare baseball cards, but purchasing those baseball cards and the baseball cards themselves are not securities or investment opportunities. And the SEC has been using a famous court case precedent to enforce what it sees as the law, which is known as the Howey test. It's worth understanding that in this case, the issue was that a contract representing a land with citrus groves in question of whether or not it was a security, and ultimately found that it was. The SEC found that Howey's use of interstate commerce to market the contract was grounds that it established the sale of unregistered securities, and as a result, the Howey test was formed by the Supreme Court to help the SEC identify what are investment contracts for future cases. And interestingly enough, of course, that case also found that it was the contract that was a security. It was not the oranges themselves, which of course are commodities that did not, they stayed commodities. They did not become securities as a result of the transaction. And, of course, now the case with Telegram, the SEC is charging that the sale of Grams is part of an overall scheme, and Grams themselves are securities, which is a fascinating twist to what was expected. And that means the SEC is saying that these pieces of software might, in fact, be securities as a result, and even post-issuance, which would make them be required to follow securities laws, where they are only available, of course, for purchase within a compliant ecosystem, which is supposed to include the U.S., by the way, because many of the ICO participants were American citizens and companies. Now, the court ended up giving out a win to both sides, to the SEC saying that the overall scheme may indeed have violated securities laws, and to Telegram that the Grams themselves are irrelevant necessarily to the SEC's case for making a case that there was an overall scheme, and not necessarily that the Grams themselves are within question. This doesn't necessarily absolve the Grams of eventually being labeled securities, but it looks like the court acknowledges that that's not what's in question, which means there's a potential path for Grams to be given clearance as not qualifying as a security. Well, it's my guess, Kyle, that there's no coincidence that within weeks of this happening, especially with this court information from a few weeks ago, that now, simultaneously, a pair of law firms have filed 11 lawsuits in the New York federal court against various ICO issuers and blockchain exchanges for violating securities laws regarding selling unregistered securities and manipulative conduct by exchanges. Many are calling this move the Red Wedding in reference to the bloody massacre featured in Game of Thrones, as a potential reference to the negative effect this may have on the crypto industry. The law firms in question are Selendi and Gay and Roche Cyrulnik Friedman, and they have named exchanges Binance, Buybox, BitMEX, and KuCoin, as well as digital token issuers Block1, otherwise known for issuing EOS, Tron for their TRX token, Bancor for their BNT token, Civic for their CVC token, Kybercoin for their KNC token, QuantStamp for their QSB token, and Status for their SNT token. In addition, there were numerous company executives, including notable names like Civic founder Vinny Lingham, Binance founder Changpeng Zhao, and BitMEX co-founder and CEO Arthur Hayes. The law firms previously represented plaintiffs in the case against Craig Wright and Bitfinex, to give you some context. Now, Philip Selendi, one of the lead partners on the cases, specifically said in an article, quote, "The crypto asset market has exploded in the last few years with ICOs that make great promises but deny investors critical information on the securities sold. Not unlike the mortgage crisis that led to the Great Recession, the alleged pattern of misconduct by exchanges and issuers yielded billions in profits for wrongdoers through a basic betrayal of public trust. The lawsuits we filed seek to restore integrity and transparency to these new financial markets." Powerful statement to show you some insight as to why they're going about these lawsuits. Kyle, I'd love to hear what you make out of all this.
Yeah, this is really interesting, isn't it? This is serious stuff. I mean, here in the U.S., the financial rules can be very strict regarding liquidity providers and the actions that they can partake in. For example, providing exchange services such as an order book, which essentially allows a full list of investors to bid on the prices that they're willing to pay to improve efficiencies in market trading, is something that's very highly regulated. And in fact, it requires a high degree of regulatory licensing even to be able to do that. It's why we see no such thing with Open Finance and their current situation. I think they have some sort of order book, but it's definitely not quite as well defined or quite as robust as what we've seen in public markets, and there's a reason for that, right? Other actions such as listing potentially unregistered securities, providing trading services to retail non-accredited investors, and even just calling yourself an exchange can be seriously frowned upon, if not outright illegal to do so without the proper licenses. This is something that I'm actually trying to change my own lingo, because in some cases I've called a lot of these marketplaces exchanges, and we have to be careful because a lot of them in fact are not exchanges, and they need to be very cognizant of that. So through both personal experience of working closely in this industry for the better part of 4 years now, as well as reading some of the details in the filed complaint, it does seem to me that many of the cited firms have engaged in some, if not all, of these restricted activities I've noted, in addition to potentially many more. So it's going to be very interesting. It does go to mention, Herwig, that we are not lawyers, and this is not legal advice in any way, shape, or form. But from a personal opinion, it seems like there have been many accounts of blurred lines regarding the securities law and the action many of these firms have taken. So many so that I've actually seen Binance recently pull a partnership with Visa for a credit card, and they were even renounced recently by the financial regulatory body of Malta, who claimed that the company was not adhering to their rules and regulations despite being officially based there. So on top of this, we've seen many other firms cited like Civic, Tron, EOS, and others conducting offerings that definitely seem to share many similarities with traditional private securities offerings. Most of these ICOs were open to retail investors, for example, and many didn't even collect KYC information from their investors. So all of these things are huge no-nos in the eyes of the law, but on top of that, with no products or services to show for the hundreds of millions of dollars that they collectively raised between all of these firms, it does seem that the investors really do have something to be upset about. On the plus side, EOS was able to fully cooperate with the SEC regarding its investor onboarding. We covered that one in a couple episodes ago. And it may have paved the way for some of these companies to move past these initial stumbles to continue innovating. Some firms like Binance, for example, have built tremendous products, and I really believe they have revolutionized capital market theory as well as user experience in the space. So I'd hate to see rulings like this ruin their momentum for firms that actually have built successful products. And this could potentially open the door for these firms to embrace the security token space through compliant measures instead of avoiding the industry altogether like we've seen. I think that the only other contrast is what we've seen from, as you mentioned, with the Gram tokens from Telegram. Telegram has been notoriously working against what the SEC is trying to do. They have not cooperated in any means, and that's caused quite a lot of issues. So it will be very interesting to see which firms decide to work in full cooperation, and if they're able to find some way to work together. Again, potentially, if they do, they'll be more open to embracing security tokens, which would be tremendous for the financial industry as a whole.
Yeah, I think you're absolutely right about all of that. It's fascinating to see how it all ties together in the sense that even with the Ripple lawsuit, we see that despite it not potentially being a security, even though it's still potentially cleared, they still violated false advertising rules and other rules. So in regards to the Telegram case, we see that that's what the court is more focused on. What are the violations that they're doing on the grander scheme of raising over $1.7 billion from investors. So it seems like there's definitely a focus, around the greater violation, as opposed to just a need to say, hey, ICOs are securities. So I think that's a good thing in the sense that, people are looking for remedy here. These law firms have identified violations where people have been hurt, and they're seeking remedy for that. But there is, of course, the possibility that as a result, these lawsuits will exacerbate the issues here in the U.S. for the crypto community, which, in my opinion, will actually force more focus on, one, specifically existing solutions like security tokens, as you suggested, Kyle, and two, of course, the need for a crypto-friendly framework and legal definition for ICOs and decentralized blockchain applications. At the end of the day, these lawsuits will ultimately set many precedents for future cases and hopeful issuers. And I hope that we're both right in that this will be both remedy for victims in any of these alleged cases, but also a call for change and clarity for the U.S. crypto community. But it's also possible that this could definitely put an end to the ICO model and hurt the larger blockchain community in the U.S. as projects shy away and look for friendlier jurisdictions due to all these lawsuits and friendly results potentially towards the regulators. We've covered it before, but change will, and then as a result, only come from legislation or from the regulators, hopefully in either the form of a bill or a rule change like making Regulation A+ easier to leverage, or by introducing a safe harbor such as Commissioner Hester Peirce's proposal. So that's the only way we'll see change, but what this will certainly do is bring a lot more potentially even global attention to both the crypto topic as well as the definition for securities versus crypto assets and the like.
I think you're totally right, Herwig. Precedent at least will lead to some sort of clarity so that issuers, technology providers, financial firms, even regulators alike will understand what has been clearly defined instead of being in a gray area. I mean, the prime question does remain regarding how progressive those precedents might be. As we've seen some indicators that the line between a conservative approach versus an innovative approach is still in the balance. I mean, we've got Hester Peirce's proposal, which seems very exciting, or some of these cryptocurrency acts. But then on the other side, there does seem to be the SEC taking a more conservative approach with a lot of this stuff, certainly what we've seen over the past couple of years, and they've focused more on clamping down on fraud as opposed to embracing innovation. So we'll definitely have to see where they continue to lean. But one thing's for sure, as these cases proceed, you can count on us to bring each and every update every step of the way. So with that, Herwig, I think that is episode 38 of the Security Token Show.
Thanks, everyone, for listening, and hope you tune in next week.